I recently did a video with 4 undervalued dividend aristocrats, and that video is in the description below. Click on that to see that original video. But after I did that video, I thought, there's 6 others that really make a good criteria for that, and so I want to do a follow-up video to show 6 other ones in addition to those 4 that had these real low price to book values. And so what we're really looking at is something that has a undervalued stock price, where the stock price has come down in comparison to its underlying assets or its book value. That's the price to book value. And there's another part of that criteria is that they're part of the Dividend Aristocrats list, and which is a very stringent, exclusive list. You got to be in the S&P 500, so it's 500 largest USA-based stocks. 25 years of paying dividends, but not only that, you have to have 25 years of increasing or raising your dividend. So if you cut your dividend or eliminate your dividend, you're out of that list. You got to do it for 25 years or more. So it's a very narrow list. So what we're really trying to do here is look at stocks that are maybe a good buying opportunity from a price standpoint with a long history of paying dividends that might make a good, especially buy and hold solution. So all that's coming up. And we're going to look at 6 real key ones you might want to consider on investing education with me, Mr. B. Welcome to the channel where we help you to learn fast so you can become a confident and successful investor. If that sounds interesting to you, hey, do consider subscribing, and in that description below, take a look at after you watch this video, take a look at the other video around 4 undervalued dividend stocks, the first 4 that I kind of looked at that had really low price to book values, even lower than the ones we're going to talk about today. And the ones we're going to talk about today are really, really good as far as that measure. Plus I have free courses and other course information below too, so the description is a good place to hang out and check out. All right, so let's look at 6 undervalued by their price to book ratio dividend stocks here. And they all have price to book ratios less than 3.0 is a kind of a threshold to start looking at those kind of numbers. And these are all under 2.0 actually. So 1.0 is the lowest of the low, so that's always a strong number to look at. But these are some you might want to consider as well as far as looking for something that's undervalued. So let's get started with that. The first one we're going to look at here is something you probably have driven by or see on almost every street corner, which is Walgreens, right? Walgreens is a big pharmacy retailer. They have tens of thousands of locations over the United States, and they're expanding in other parts of the world, is my understanding too. And so they do, they have testing like COVID testing. They do vaccine type stuff, glasses, RX for filling your prescriptions, and they sell like snacks and stuff too. So they're big retailer in certainly a strong growing area, which is the healthcare segment. And they've been in and they're in that Dividend Aristocrat list. So let's take a look at them as far as Walgreens and see how they look from the price to book and their dividends. So we're going to put in their ticker symbol, which is actually Walgreens Boots Alliance. That's the holding company because they've had some mergers and things like that over the years. So, but you might know them more familiar as Walgreens. And so let's look at some of the numbers here. I'm going to go under statistics here, and we're going to look at that price to book value. So just clicking on statistics, close that up. And we're looking for price to book value. And we want that number to be ideally below 3.0. Anything lower than that's good. Under 2.0 is really being a good target. 1.0 is kind of the holy grail. Under 1.0, looking at that price relative to its underlying assets. So very attractive at 1.52. Again, for a well-established company with many assets and locations. So 1.52 on that price to book. So meets that criteria. Let's look at their dividend. What kind of dividend they pay out? Is it a good dividend? Actually, it's a pretty solid dividend, 4.03%. The average dividend in the S&P 500 is like around, was it 2.2 or something like that? So above 4% is a solid dividend relative in terms of its yield, looking at the price relative to the dividends paying out. And can it continue to pay that dividend? And that's one number I like to look at quickly is the payout ratio. We want that number to be below 80% ideally, but anything below 50 or 40 is really good. They're at 27.47. So long-term dividend-paying companies don't want to cut their dividend. They want to maintain that. Those are companies that get picked up by big ETFs and mutual funds like Vanguard and Fidelity. So, and their investors are looking for that dividend. People cut their dividend, the stock goes plummeting. So, the fact that they can pay out that dividend pretty easily with a 27% paying dividends out of their net income is pretty solid, especially since it's a pretty solid dividend, 4%. And they don't carry much debt. They got a good amount of cash, $4 billion. I meant to say they actually carry quite a bit of debt, $39 billion of debt. and their current ratio, we like to see that number above 1.0. Being able to meet their current obligations is what that's telling us. So we want it to be above 1.0. Just a real quick thing. You learn about all this stuff in my courses, but that's just a quick number to look at. So that's a little concerning too. So I'd be worried about that debt, and the current ratio I'd look at further. But again, they're still solid in that payout ratio. They might not raise their dividend as fast, but I doubt they would cut it. So look a little further. With all these stocks, it'd be a matter of looking at it a little bit closer and fuller on your own, not making a strong recommendation, just something to understand from an education standpoint and whether you might want to look further at a stock. All right, we got 5 others to go here quickly. This is an interesting one, which is Realty Income, the monthly dividend company, right? And what they are is they're a REIT, an R-E-I-T, Real Estate Investment Trust, and they invest in real estate. And you can see some of the real estate they invest in. If you live in the United States, you'd recognize some of these brand names like Home Depot, a big hardware store, of course. And they say here they have a 53-year track record of providing dividends. And you can see, if you look a little closer, 619 consecutive monthly dividends paid. Now, this is where they're unusual. They pay out a monthly dividend. Most dividend companies pay out a quarterly dividend. So if you want something that's more of a consistent monthly return, maybe you're using it to help pay your current bills possibly, or just like that idea of getting paid monthly in your dividends. This is a company that's part of that Dividend Aristocrats. So that's at 25 years of paying dividends and raising their dividends. So, and they're a big company, being part of that S&P 500. 97 consecutive quarterly increases in that time as well too, so that's very interesting. So they pay these monthly dividends. So let's take a look at Realty Income, this real estate investment trust, and their ticker symbol is a real hard one. I'm gonna go over here so I can pull right up to the statistics part. Is O. You have to find here Realty Income, or otherwise you can just type it all in. Realty Income. And you'll eventually find it after all these other real estate stocks, but their ticker is just the simply O, Realty Income. We're underneath statistics here on Yahoo Finance. Let's go take a look at their price to book, 1.55. Real good value, again, price to book, below 2.0. Is it below 1.0? No. But 1.55 for a consistent dividend payer that's paying a monthly dividend, that might be something that jumps out. Let's take a look at some of their numbers. Now, again, they're paying out a monthly dividend, but the forward dividend yield, that's a yearly number. So you'll get your smaller monthly numbers, and that'll add up to an overall yield of 4.53%. So again, a strong, high dividend payer. And we expect that with real estate investment trusts or REITs. They're designed to pay out most of their income to dividends to shareholders. Whereas some companies hold back their income and use it to, open new locations or finance growth or come up with a research and development. Certainly growth companies are like that, where they do that. Think of like Google or Tesla, where they're investing in the company. Real estate investment trusts are all about getting that money back to their shareholders. So that's pretty solid at 4.53. Concerning number is the payout ratio, and something I would encourage you to look really closely at. Now, you saw they had all these consecutive quarters and months of paying dividends. We want that payout ratio to be below 80%. They're at 327 right now. That's concerning. Now, again, they're a real estate investment trust. They normally pay out a higher number. That's perfectly fine, but 327 is like, wow, astronomically high. How are they doing with their cash on hand? 258 million, 16 billion of debt. Not unusual because they're, investing in real estate, so they're carrying more debt, as far as that goes. But their current ratio, 0.73 versus being below 1.0. High debt to equity number. Some things that are concerning around that. So before you get all excited and say, wow, monthly dividends, I want a part of that. I love that 4.53%. And I love that it's a real low price to book value at that 1.55. Look at some of those debt things, and look at some of the things around the company that they're making statements around, possibly reducing or slowing down their dividend payments. They don't want to do it, but it's just something to be aware of. All right, the next one here. Now we're going to get into energy. We're going to look at I'm going to go real quick on these 3 energy stocks because they're falling right in this criteria. And you might not want to invest in them because they are energy stocks, like Chevron, right? Old fossil fuel energy, right? And they do other things too, but you can see they do natural gas, conventional gas. They do all sorts of stuff all over the world is what they do. And Chevron, they got like a project like Project Gorgon here, a big project in Asia Pacific and all that. So they're a big, traditional oil company, right? That you would think of. And I'm going to go quick through these next three because they're all somewhat similar. They're all energy companies, a little different flavor on a couple of them. So Chevron recently just had a downgrade, by the way, saying that they would not do as well as some of their competitors. So you can see their stock is down at the date of recording this. Price to book below 2.0, but not as attractive as those others at 1.5. They're at 1.97. You can see they were at a better attractive numbers before we start seeing some, from the Russian Putin invasion, some constriction around oil supply and demand and all that, and our gas prices going up. That helps energy stocks. So you can see their price relative to the book value. The price is now gone back up a little bit compared to where it was here. So, but still 1.97. Dividends, energy companies pay solid dividends, 3.32, 65% on that yield, 65% on that payout ratio. They can carry a lot of debt because they got a lot of cash, 5.67 billion. They can help carry that debt. 1.26 current ratio. Again, we're looking to be above 1.20. They're going to be fine, right? And they've been paying the dividend for a long time, certainly well over 25 years to be included in that. Now, Chevron, you might say, yeah, but I don't want to invest in oil companies, and that's perfectly fine. But they did meet the criteria. The other one that met the criteria is their friend, Exxon Mobil. May not be your friend, but another big oil company, right? So another big oil company. Let's go take a look at Exxon Mobil real quick here. And if we go down, they're at a 1.95, so just below that 2.0 threshold. And you can see kind of the same thing. They were at a 0.98. A few years ago. Now they're at 1.5. So their price has gone up a little bit in comparison to where it was. 4.15% of that dividend, 64% payout ratio. Similar type things with carrying a lot of cash, but carrying a lot of debt and above 1.0 on that current ratio. So you can look at Exxon Mobil. So Chevron and Exxon Mobil, very similar, direct competitors. The third one of our little energy thing, and then we got one more after this guy, is Atmos Energy. And they're out of Texas. If you recognize this picture, that's the Dallas skyline. So if you like the old show Dallas or been to Dallas, so that's Atmos Energy. And they're more involved with like natural gas, right? So in movement of natural gas. And you can see they're more limited. They're part of the S&P 500, been paying dividends out for 25 years, raising the dividends for 25 years. But you can see their operations here, is a more limited scope than, let's say, like Exxon or Chevron, which is more international in scope. And their price went down because they were caught up on a lot. Let's go take a look at Atmos while I'm talking here, ATO. And they got caught up in some of the, the problems with the infrastructure in Texas in particular. If you remember that from a few years ago, where there were blackouts and all sorts of things and how they manage their energy. So some things around that. Price to book, and that was years ago. But price to book is 1.78, so, below 2.0. It doesn't pay as high a dividend. So if you get in those bigger oil companies, you're going to get that 4% dividend yield here at 2.39. Again, dividend yield, you're comparing it to other stocks that pay dividends. You compare it to, let's say, savings accounts or other types of investments for income giving you on a yearly basis. Remember that that Realty income one was the only one that was a monthly basis. These are all quarterly basis. So 2.39 payout ratio, 48%. So, no problem paying out the dividend here. And they've been doing it a long time. Carrying, again, a good amount of debt relative to their sales. 0.96, they're right there with the current ratio. We'd like to see a bit above 1.0, but it's not the end of the world. They can always, again, take on a little more debt if they, have a problem meeting a dividend payment. But again, when you're not really raking in the money, to, in terms of that, that current ratio or being able to, finance those in short-term debts, that's something where they might not raise their dividend as fast as maybe we would like them to raise it, but at least they won't cut it. And you can lock in that, 2.3%. Was that 2.39%? Yeah, okay, sorry for going faster. And the last one here is something different, not energy, thankfully. We can look at something different. But another smaller company, still part of the S&P 500, but is a Cincinnati insurance companies, right? And they sell insurance, and they primarily sell insurance to businesses, and they sell to insurance individuals as well, home, auto, life, kind of the standard selection of insurance products there. And they sell a lot of insurance products to businesses too, as well as far as a variety of products. You can see, from cyber risk to auto for businesses, life insurance that companies would issue them to their employees, liability, management liability, marine insurance, inland, not ocean going, but maybe river going. So they do a lot of insurance, and they sell through brokers, right, who then resell their insurance. So let's take a look at their numbers here. Cincinnati Financial Holding Group, CINF, Financial Corporation, CINF. You can see they're missing some data here. So that's, again, you'd want to look at some of these things to find out why is it missing the data. Maybe it's just simply as simple as Yahoo not pulling their data from their financial statements, Cincinnati financial statements, which is what they do, Yahoo automatically. So some things may look at. So the price to book is at 1.50, so right there. You can see they've actually done well over the last year, up 11.7% compared to the S&P 500, up about 6% at the time of this recording. Over the last year, more short-term, been in struggle, but over the last 52 weeks. We scroll down here, they're going to pay a nice small little dividend, 2.27, oops, excuse me, 2.27, but that's, it's right in line with kind of the average. Super low payout ratio, 13.92%. So no problem they're showing as far as paying out of their current income coming in, paying dividends out of that income. They don't have to draw down from their existing cash. They don't have to borrow to pay that dividend. They've got that low 13.92% payout ratio. I would look and do some more research on the company and see, might they raise their dividend? Are they talking about that? That would be something to watch for, because they could certainly afford it from a payout ratio standpoint. And certainly look at their cash, 1.14 billion in cash, and total debt 897 million, less than $1 billion in debt. So if they wanted to wipe out all their debt right now, they could write a check. They could pay it all out of cash holdings right on hand. So this is looking very solid as far as its ability to do that. The only thing that's a little interesting and concerning is their current ratio, well below 1.0. It's 0.68. So I'm not sure why that is. That'd be something to take a look at. But good debt to equity compared to the other companies, 6.84. So that'd be something to watch for as well. But overall, if you look at just the payout ratio and the dividend, not a high dividend, but you're going to lock in that 2.27%, and maybe they'll raise it over time as well. So there you go. There's some stocks there, 6 stocks that you can look at. Again, I did 4 that when we were talking about those price to books, the first 4 that I did and linked in the description below had even lower price to books, but it didn't necessarily mean they were the best in terms of a dividend, type thing, certainly a high dividend. So take a look at that video if you like. I think that's very interesting. That's still Dividend Aristocrats, but these 6 are interesting as well. And again, you need to do your own due diligence on that and look deeper in it before you invest. That's the idea. So again, the description below has the links to the other video. Do subscribe is great. We like that. We like these types of videos. And also check out, we have free course and really discounted courses at Investing Education with MrB.com. So do check that out as well. So with that, I wish you all the best of luck, and I hope your dividends keep flowing to you.